Melissa, I think the market's still trying to believe the Federal Reserve. I mean, every one of these market pullbacks has been on the heels of some Fed governor, if not Jay Powell himself, coming out and saying some version of "we really mean it this time. We're going to take them up a half a point next time. We're going to do more. We're going to be really serious." And I think part of this is the Fed in many ways has lost some credibility of being the tough guy with markets, of really laying down the law. Because every time the markets have gone down, the Fed has been there with ample cash. So I'm not sure markets are still convinced that they're going to go through with it. And so to your question, how much is priced in? Probably about half. And I think every one of these further announcements, you're seeing the market react and say, gee, they really mean it this time. Markets, I think we have to take them at their word here, that they do really mean it. And Wells Fargo came out today and said they expect a half a point in May, half a point in June, 3 more hikes this year, 3 more hikes in the beginning of next year, and we're going to a Fed funds rate, according to Wells Fargo and my friend Jay Bryson, Dr. Jay Bryson, their chief economist there, 3.25% on Fed funds. That takes the 10-year to 3.5, 3.75. Markets aren't expecting that yet. So some of it's priced in, and some of it needs to be taken a little more seriously.
I think that's a great point that Michael is making, Josh, in that, some markets are in fact pricing in all this tightening. If you take a look at Fed funds futures, for instance, and what they're pricing in terms of the cadence of rate hikes and the size of rate hikes. But the equity markets don't feel like they're fully pricing all of that in on top of what we learned yesterday about the balance sheet runoff.
Yeah, I think that's a good point. Look, this is what I would tell you. The VIX is up 12% in the last 5 days. That is a fairly large increase, up another 2% today. You have some outperformance in areas that are not thought to be as susceptible to the economic cycle, like healthcare, consumer staples outperforming. I would note biotech. I talked about it yesterday. Looks pretty good. But outside of that, I'm looking at 52-week lows in Goldman Sachs. I'm looking at a 30-year fixed mortgage, now 4.72. That's the fastest 3-month rise going back to 1994. The market is stock market, very rapidly catching up to the reality that the bond market seems to have been on to first. There is a tendency to overshoot, though. So I think we're probably going to retest those February lows in the large cap, quote-unquote, quality stocks. I don't know how that retest is going to go. I don't know what the overall headline situation is going to be at the moment that we do that retest. But I really feel that that is what professionals are focused on right now. That's going to be one of those moments in truth that we seem to have every year or so as stock market participants. So until that happens, if you're a trader, you're probably out there tightening up your stops, maybe letting a lot of setups go by. If you see 10 setups, maybe you're only taking the best 2 or 3 pure breakouts, and you're probably not doing your 3rd, 4th, or 5th best trade. And if you're a long-term investor, you're probably looking for stocks that have already been cut in half that you want to own for the long term, and you're willing to be wrong or early by 10 or 20%. Outside of that, I don't think this is an environment where you want to think you're smarter than the market. We're seeing this phenomenon where you get a rally in tech stocks for 4 or 5 days. All of a sudden, you think you have it figured out, and then you give up that whole rally in 3 hours. That's not a fun environment for hobbyists or retail traders that are only kind of half looking. So if you're in that boat, probably do less is the right default.